Capital structure. Capital structure is the combination of capitals from different sources of finance. The capital of a company consists of equity shareholders' fund, preference share capital, and long-term external debts. The source and quantum of capital is decided keeping in mind following factors. Control. Capital structure should be designed in such a manner that existing shareholders continue to hold majority stake. Risk. Capital structure should be designed in such a manner that financial risk of the company does not increases beyond tolerable limit. Cost. Overall cost of capital remains minimum. Practically it is difficult to achieve all of the above three goals together, hence a finance manager has to make a balance among these three objectives. Capital structure decision refers to deciding the forms of financing, which sources to be tapped, their actual requirements, amount to be funded, and their relative proportions, mix, in total capitalization. Value of the firm is equal to EBIT overall cost of capital by weighted average cost of capital. CO is equal to cost of debt into weight of debt, plus cost of equity into weight of equity. CO is equal to KD into D by D plus S, plus K into S by D plus S. Where CO is the weighted average cost of capital, WACC. KD is the cost of debt. D is the market value of debt. S is the market value of equity. K is the cost of equity. Capital structure decision will decide weight of debt and equity and ultimately overall cost of capital as well as value of the firm. So capital structure is relevant in maximizing value of the firm and minimizing overall cost of capital. Capital structure theories. The following approaches explain the relationship between cost of capital, capital structure, and value of the firm. However, the following assumptions are made to understand this relationship. There are only two kinds of funds used by a firm, that is debt and equity. The total assets of the firm are given. The degree of average can be changed by selling debt to purchase shares or selling shares to retire debt. Taxes are not considered. The payout ratio is 100%. The firm's total financing remains constant. Business risk is constant over time. The firm has perpetual life. Net income, NI, approach. According to this approach, capital structure decision is relevant to the value of the firm. An increase in financial leverage will lead to decline in the weighted average cost of capital, WACC, while the value of the firm as well as market price of ordinary share will increase. From the above diagram, K and KD are assumed not to change with leverage. As debt increases, it causes weighted average cost of capital, WACC, to decrease. The value of the firm on the basis of net income approach can be ascertained as follows. Value of firm, V, is equal to S plus D, where V is equal to value of the firm, S is equal to market value of equity, D is equal to market value of debt. Market value of equity is equal to NI by K, where NI is equal to earnings available for equity shareholders. K is equal to equity capitalization rate. Overall cost of capital is equal to EBIT by value of the firm. Thus, according to this approach, the firm can increase its total value by decreasing its overall cost of capital through increasing the degree of leverage. Traditional approach. This approach favors that as a result of financial leverage up to some point, cost of capital comes down and value of firm increases. However, beyond that point, reverse trends emerge. The firm should strive to reach the optimal capital structure and its total valuation through a judicious use of the both debt and equity in capital structure. At the optimal capital structure, the overall cost of capital will be minimum and the value of the firm will be maximum. Optimum capital structure occurs at the point where value of the firm is highest and the cost of capital is the lowest. Net operating income approach, NOI. NOI means earnings before interest and tax, EBIT. According to this approach, capital structure decisions of the firm are irrelevant. The above diagram shows that overall capitalization rate, and debt minus capitalization rate, are constant and K, cost of equity, increases with leverage. As per this approach, an increase in the use of debt which is apparently cheaper is offset by an increase in the equity capitalization rate. This happens because equity investors seek higher compensation as they are opposed to greater risk due to the existence of fixed return securities in the capital structure.